On August 24, 24,000 Bitcoin were sold in a single transaction. In just minutes, more than $50 billion vanished from the market. That sudden dump triggered liquidations across the board. Countless retail traders got wiped out instantly. But here's the point. The problem isn't the drop itself. Bitcoin moving a few $1,000s in minutes? That happens all the time. The real problem is this. One whale, one account, can shake the entire market. That's concentration risk. And this isn't the only structural risk in Bitcoin. I've talked about the broader, macro risks in another video. Feel free to check that out if you haven't seen it. But this particular event highlights another issue we need to pay attention to. Bitcoin is supposed to be decentralized, but in reality, holdings are very concentrated. According to Glassnode and BitInfo charts, just a few thousand addresses already control more than 40% of supply. One exchange cold wallet can hold over 100,000 BTC. And corporate whales are even more extreme. Take Strategy, formerly MicroStrategy. They hold over 630,000 BTC, around 3% of the total supply. So whenever a big player makes a move, the entire market can shake. This means a small group of holders can trigger domino effects, not just price swings, but sudden liquidation cascades across the system. Here's the problem. Strategy isn't a miner or an exchange. It's just a business software company. Their core business makes about $500 to $600 million in revenue a year. Profits are thin, sometimes even losses. But their Bitcoin bet is huge. They've raised tens of billions through bonds, stock sales, even pledging Bitcoin. By 2025, their BTC holdings are worth tens of billions, while their software business looks tiny in comparison. But the truth is, this isn't sustainable growth. It's leverage stacked on top of leverage. And once that chain breaks, it doesn't even take a Bitcoin crash to spark a crisis. Let's see their financing path. 2022. Bought with cash, even pledged BTC for loans. June 2024. Issued $500 million convertible bonds. October 2024. Raised $2.03 billion through equity, bought 27,200 BTC. February 2025. Issued $2 billion zero coupon bonds, plus $300 million option. June 2025. Another $680 million raised, plus nearly $3.5 billion more via equity. You can see their fundraising scale growing every year. Back in 2020, it was only a few hundred million. But by the first half of 2025, in just 6 months, they had already raised more than $6 billion. Strategy isn't alone. Globally, more than 100 public companies together hold nearly 1.5 million BTC. That's about 7% of total supply. Most miners just keep the coins they mine. Exchanges and financial firms hold BTC as investments or liquidity. But companies that borrow or issue stock just to buy Bitcoin? Still rare, only about a dozen. The danger is, strategy looks successful on the surface. So others may follow. If more companies start copying this model, the market could become dangerously dependent on just a handful of balance sheets. That's not decentralization, that's fragility. This whole model depends on capital markets. Step 1. Raise money with bonds or stock. Step 2. Use it all to buy Bitcoin. Step 3. Pay expenses and interest with the next round of fundraising. It's a rolling strategy, but if one day, investors stop buying their bonds or shares, the chain breaks. They'd be forced to sell Bitcoin, even if the price never goes back to their cost basis. In fact, the biggest threat may not be Bitcoin's price itself. The real danger comes when capital markets shut the door. If funding dries up, forced selling becomes inevitable, even if Bitcoin never falls back to their entry price. So, that 24,000 BTC dump is just one reminder. A single whale can shake the entire market. And when corporate whales like Strategy have fragile finances, any liquidity crisis could force them to unload hundreds of thousands of BTC. If that happens, it won't just hit Bitcoin's price. It could trigger a chain reaction that undermines trust across the entire digital asset market. That's when the real confidence crisis could hit. And it could shake the whole story of corporate Bitcoin adoption. On the surface, whales buying Bitcoin looks like support. But in reality, the risk just gets higher and higher. If you're investing in Bitcoin, remember this. Your biggest risk may not be the market itself, but the funding chain of a few whales. Share your thoughts in the comments, and don't forget to subscribe. I'll keep tracking the biggest hidden risks in this game for you.